Hey guys, this video is for Econ class Macroeconomics Chapter 13. Just going to summarize the chapter quickly, go through the slides. Just a comment before I start. I'm trying to keep the videos, I'm basically turning a 3 hours worth of lecture or so into like a 20-minute video. So again, it's going to be pretty brief, but I recommend just reading through the textbook for a little more context, a little more information. And as far as communication goes, I've talked about this in other videos. I kind of forget which ones I say it in, but you could even just comment in this video. If you watch this video in your econ class, just comment and say your name and say that you saw it. Then I can record that as you keeping up and engaging in the class, and I can put that on our information sheet just to make sure that Ange and Barb know that you're still participating with the classes. So let's get into chapter 13. So macroeconomics chapter 13 is looking at fiscal policy, deficits, and debt. So to start out with fiscal policy, I'm sure people have heard of that a little bit before. Basically, fiscal just meaning like financial, and then policy having to do with the government. So that's deliberate changes in government spending and tax collections designed to achieve full employment, control inflation, and encourage economic growth. So it's just the financial policies of the government, basically. How are they spending their money? How are they taxing? And typically they're doing it to trying to control things like inflation and employment and encourage economic growth. And this stuff is pretty important lately, where we're seeing a lot happen macroeconomically. So the government is, Canadian government, American government, other governments are stepping in with more fiscal policy to try and help with what's going on with the pandemic. So it's a pretty interesting time to observe this type of stuff and learn about it as well. So the fiscal policy and the aggregate demand, aggregate supply model. So aggregate demand and supply, that's one of the major components of macroeconomics that we've been looking at. So the government's, fiscal policy is a relatively new thing in some ways. It's stabilization policy. So the government uses financial policy or fiscal policy to try and stabilize the economy, or so they think. Just changes in government spending or taxes at the option of the government. Yeah, we've kind of covered this stuff already, where it depends who's spending, but if the government spends $5 billion, you might have the multiplier effect, which could increase GDP to $20 billion. So it'd be a multiplier effect of 4, because the government has implemented some fiscal policy for expansion. In this case, maybe they're spending $5 billion on whatever I said a month ago, airport and the science center or something. And that ends up leading to more flights, more use of the airport, more visits to the science center. So it ends up having the $5 billion increase leading to a $20 billion increase in aggregate demand. So that's a 4 multiplier effect. So there's also contractionary fiscal policy. This one was expansionary, where the government would be implementing things to try and expand the economy, whereas contraction, they're trying to shrink the economy. So that can be used to combat demand pull inflation. So we've talked about demand pull inflation. That's where basically the cost of living or cost of goods and services is going up because there's high demand for them. It's too much money chasing too few goods, and so you kind of get into bidding wars where things become more expensive. Options with contractionary fiscal policy would be decrease government spending, increase taxes, or a combination of the two. So if there's too many dollars chasing too few goods, governments might step back and reduce their spending, or they might increase taxes so that people have less disposable income to demand goods and services, so that there is less money chasing those goods and services. With this chapter, I forgot to mention, I've reduced it a little bit compared to the slides that are on PowerPoint and that were in the homework packages. I just kind of got rid of some graphs and stuff. This would be, I don't know why that says expansionary. I think that should be contractionary. Yeah, that should say contractionary at the top there. So yeah, they're just reducing aggregate demand by perhaps increasing taxes or reducing spending. So in the case of a recession, the government will increase spending. If inflation, then it increases taxes. So that's what we're seeing right now, where we're pretty much guaranteed to be in recession or going into recession. The government is going to increase their spending, so they're trying to stimulate the economy. They're giving out more EI, they're giving out the CERB or whatever, and probably giving money to different businesses and stuff. If there's inflation, then increase taxes. So yeah, I already went over that. If recession, then decrease taxes. So that's if there's a recession, that might be one method to increase spending, increase demand, is by reducing people's taxes so that they have more disposable income to spend. If inflation, then decrease government spending, so trying to reduce the size of the economy. Next thing is built-in stability. So there are some built-in stabilizers for the economy when governments exist, I guess. So things like net tax revenues vary directly with GDP. So taxes rise when GDP rises and vice versa. That's largely because places like Canada, we have progressive taxes. So when GDP rises, when we're consuming more, we're spending more, taxes rise because the more we spend and the more we earn, the more we pay. On the flip side, transfer payments will fall when GDP rises and vice versa. That's in the same situation. So when we're in an expansionary economy, transfer payments, meaning things like unemployment payments, those will fall as GDP rises. Yeah. The opposite would be like when you're in recession, there would be less taxes. If people are earning less and less people are working, and transfer payments would rise when we're in recession. So meaning when there's recession, there's less people working, less income, therefore government is spending more through this built-in form. They're spending more on paying out unemployment. So these stabilizers will automatically restrain economic expansion and cushion economic contraction. So just, yeah, again, with fiscal policy, they're just trying to stabilize the economy. Taxes reduce spending and aggregate demand. Of course, the more you're taxed, the less disposable income you have. Reductions in spending are desirable when the economy is developing inflationary pressures. So when prices are rising too much, when there's too much money chasing too few goods, that's when we start to have inflation. So reductions in spending can combat inflationary pressures. Increase in spending are desirable when the economy is slumping. So when things are slowing down, the government may enact fiscal policy to stimulate demand, and so they might spend more. So as I mentioned, tax progressivity, that's the built-in stability that we have. I'll show you here. Oops. Let's go back. I'm going to show you Canada's tax rates here. So with progressive tax rates, what we mean by that, here, these are the federal income tax rates for Canada. So the tax rate is 15% on your first 48,535 of taxable income, but the tax rate gets much higher as you earn more. So all the way up to 33%. So if you have an income of over $214,368, it jumps from 15 to 33%. And so that's federal tax, but then there's also provincial where it's a progressive, with the exception, oh, I guess Alberta is progressive too, but Saskatchewan is progressive. So the higher your taxable income, the higher percentage you pay in taxes. Let's go back to the PowerPoints here. Okay. So the built-in stability depends on how progressive taxes are, proportional or regressive. The more progressive the tax system, the greater the economy's built-in stability, meaning that the more the economy is expanding, the more people are earning, the more taxes they're paying, which means more money going to the government. So it prevents too much expansion, if that makes sense. Whereas when the economy is contracting, people are paying less taxes. So evaluating expansionary, contractionary fiscal policy, adjust deficit and surpluses to eliminate automatic changes in tax revenue, compare adjusted budgets to GDP. So deficits just meaning when government is spending more than it's collecting tax. Surplus, the opposite, where it's spending less than it's collecting. So they're having money left over on a quarterly basis or annual basis, typically would be measured annually. A cyclically adjusted budget, that shows what the budget allowance would be if the economy were operating in full employment, meaning no real unemployment. Just a timeline of recent Canadian fiscal policy. So that's a big year there, 2008, 2009. So 2008, Canada Economic Action Plan and the federal budget moved quickly to a deficit. In 2009, expansionary fiscal policy. So that's when we had that global economic collapse, basically, that started in the US, and we watched the movie on that. So in 2009, the Canadian government was really trying to, what's the word, like kind of stimulate the Canadian economy after a great recession. So they used expansionary fiscal policy, meaning they went into deficit spending more to try and stimulate the economy, and they did other things like cutting interest rates. Let's see what else. Problems, criticisms, and complications of implementing fiscal policy. Problems of timing, so recognition lag. Sometimes it just takes a while to recognize what's actually happening, to get the statistics in, to recognize trends, things like that. Administration lag, whatever that may be, recording the numbers, or just with government policies might take a little while to figure things out. Political considerations. So with fiscal policy, politicians are often seeking power and can be self-serving and doing things not so much for the good of the people, but for the good of themselves or certain lobbyists or whoever it may be. So sometimes fiscal policy can happen in that way, where it's not really serving the best interest of the people. Future policy reversals, if people believe that certain fiscal policies are going to be temporary, it's going to impact their behavior, which we've discussed a little bit already in previous classes. And then offsetting provincial and municipal finance, where you can read a little more in your textbook about this, but it's basically just saying, like, oftentimes provinces and cities will spend less in times of recession, where typical fiscal policy would call for the opposite. But it's like when we're in a time of recession, there's less money going to the government, therefore they want to spend less. So the federal government may try to offset that and spend even more in recession and spend less in expansion. Next thing is a crowding out effect. Expansionary fiscal policy may lead to higher interest rates and therefore a reduction in interest-sensitive spending. So if there's an expansionary fiscal policy, higher interest rates, if there's higher interest rates, people are less likely to borrow, less likely to invest in capital, things like that. So it can kind of offset the point of expansion. Fiscal policy in the open economy. Open economy meaning being able to trade with other countries, shocks originating from abroad. So economies are open to unforeseen international aggregate demand shocks. So that example there, Canadian economy was affected by the turmoil in the US housing and financial markets. So we were largely dragged down because of what happened in the United States back in 2008 and 2009. So that can mess with our fiscal policy, or even demand for whatever uranium or potash from other countries. If they all of a sudden stop demanding that, that can mess up our economy from something abroad, that can mess with our fiscal policy. So fiscal policy and the net export effect. first looking at expansionary fiscal policy. So that's when the government's trying to expand the economy, usually through spending. If the problem is recession and slow growth, expansionary fiscal policy can create higher domestic interest rate, increase foreign demand for dollars, dollar appreciates. So when the dollar appreciates, that means our dollar becomes more valuable relative to other fiat currencies. Net exports decline, meaning we're exporting less if our dollar becomes more valuable, which we've talked about in past classes. If other countries' money becomes less valuable compared to ours, our goods then become more expensive to them, and they would then export less. Aggregate demand decreases, partially offsetting the expansionary fiscal policy. On the other side, contractionary fiscal policy, if the problem is inflation, the government may implement contractionary fiscal policies, lower the domestic interest rate, which decreases foreign demand for dollars. Our dollar then depreciates, becomes less valuable, and net exports increase. So if they're trying to contract the economy, this can offset that, where we end up having higher exports because the fiscal policy can end up depreciating on our dollar, making it less valuable, meaning other countries can buy our goods for cheaper than they could before. Next thing is just looking at deficits and surpluses, public debt. So this is stuff that we've covered already in some form, but a budget surplus is just the amount by which the government revenues exceed government expenditures. So if the government's collecting taxes, which is their revenue, if they've collected more taxes than they've actually spent, they'll have a budget surplus. The opposite is if they are spending more than they've collected in taxes, they would have a budget deficit. And then public debt is the accumulation of all past deficits and surpluses. So if you continually have a $10 million deficit, your public debt is going to increase every year by 10 million or $10 billion or whatever it is. So after 10 years, you would have $100 billion as public debt for 10 years of 10 million or $10 billion budget deficits. So that's just the accumulation. GDP and debt. So relative size of the debt fell in the last decade, but rose after 2009 Great Recession again. Our debt is among the lowest as a percentage of GDP among world's industrialized nations. We still have really high public debt, and so does the United States. Our debt is growing. It might just be falling as a percentage of our GDP, meaning our GDP is growing at a quicker rate than our public debt is growing. As far as public debt, interest charges, that's a primary burden of debt, is the annual interest charge. So the debt we're carrying has interest charges, and you can look this up with the US and stuff. They have such huge, it's like $20 trillion in public debt. They're paying insane amounts of interest in interest for that public debt. About 80% of the total debt is held internally, meaning domestically, and about 20% of the gross federal debt is held by foreigners, whether that's individuals, banks, governments. So just a graph from your textbook, the gross federal debt as a percentage of GDP. So it did go up here in the late 90s and then drop down. This isn't measuring how much debt we have. Again, this is as a percentage of GDP. So our debt is actually going up as a dollar figure, but maybe our GDP is rising and therefore it's a smaller percentage. So publicly held debt, just a chart from your textbook, international comparisons. Canada has one of the lowest public debts as a percentage of GDP among advanced industrial nations. So there's Canada. So that's probably 90% public sector debt as a percentage of GDP for the year 2015, compared to Japan, which is more than 2 times their GDP. So United States, even though they have extremely high public debt, they also have very, very high GDP. Just a breakdown of the ownership of Canada's net public debt. So about 50% 57% of the federal government debt is held by the public and the chartered banks. So held by Canadians. So our chartered banks are individuals that owned bonds. And then the Bank of Canada has 14% of it, and then non-residents. So that foreigners, foreign companies, foreign governments, foreign banks, things like that. Concerns, unfounded concerns regarding the public debt. You know, with Canada having all this public debt, will we go bankrupt? Governments don't really go bankrupt, even if they have huge amounts of debt. They just can refinance it, you know, selling more bonds to banks or Canadian individuals, or taxation. They can just tax individuals more. Canada owes a substantial portion of the public debt to itself, so meaning a lot of our debt is owed to Canadian banks, to Canadian bondholders, things like that. Some other issues regarding deficit surpluses and the federal debt: income distribution, incentives, foreign-owned public debt, crowding out, revisited. So income distribution, having to do with wealthier groups. You'll have to read the textbook a little more on this. I forget the complete explanation, but in this context, having to do with how many of the bondholders of Canadian debt are wealthier individuals to begin with. So in order to, if we want to reduce our debt, it's like the rich are going to just buy more of those bonds, and you're going to have to tax people more. Yeah, I can't remember exactly. You'll have to check the textbook, sorry. Last slide for this chapter is just the last word. And this is just a breakdown. You can recall we talked about per capita quite a bit already in this class, but this is provincial per capita net debt. So Alberta, at least in 2016, was very well off, where they didn't have net debt. Whereas Saskatchewan, we were also fairly well off, where it's saying your average person in Saskatchewan has 6,856 of public debt. That doesn't mean the individual has that much debt. That means the province would have so many surplus added up that we have that much public debt, and then you're dividing that public debt by the number of individuals living in the province. The federal government has per capita debt of about 19,000. So meaning your average Canadian living in Saskatchewan has a total net public debt of $27,000 between provincial and federal debt. But yeah, that's it for chapter 13. As always, just send me an email if there's any questions on the chapter, and definitely read through the textbook just for a little more context. But hopefully that helped just break it down and summarize it a little bit. There's also, if you want more explanation, besides reaching out to me, you can also just check YouTube, like the Mr. Clifford videos are good too. But yeah, thanks for watching, and feel free to comment below that you saw the video.